Hi, my name is Allan Madan. I'm a chartered accountant and a tax expert in the Toronto, Mississauga, and Oakville regions of Ontario, Canada. Today's short video is called Tax Guide for Canadians Buying U.S. Real Estate. A lot of my clients and potential clients are calling me about the tax implications of investing in U.S. real estate because it's the perfect mix. The Canadian dollar is high. The U.S. prices are at an all or near time low. And number 3, rents are pretty good. So I'm going to tell you 3 ways to buy U.S. real estate. Number 1 is through an LLC or limited liability corporation. Despite what you've heard in your seminars by U.S. gurus, this is not the right way to invest for a Canadian. It works well only for U.S. residents or U.S. citizen. By way of a background, an LLC or limited liability corporation allows for limited liability protection, which means that in the event of a lawsuit, your personal assets aren't at risk, and the LLC does not pay any tax on the income. Only the shareholders or members of the LLC do. It doesn't work well for Canada because an LLC is considered to be a foreign corporation by the Canada Revenue Agency. This means any tax paid on the income from the LLC is not credited to you here in Canada. Additionally, any cash distributed from the LLC's profits to you here in Canada will be subject to tax as dividends in Canada. So you see, you're being taxed twice. So how do we go about doing it? This brings me to the second tax structure. It's really simple. You buy the property in your own name, you're entitled. In this particular case, you file a U.S. tax return 1040-NR, which is due on June 15th. You report the gross rents collected and the expenses. Expenses are deductions, and they include property taxes, utilities, insurance, mortgage interest, depreciation, repairs, fees paid to a property manager, supplies, and so forth. While you pay tax in the U.S. on your 1040-NR U.S. return, you also include an income, the same profit, in your Canadian return. So it sounds like you're being double taxed, but you're not, because you receive a foreign tax credit on your Canadian return for the U.S. taxes paid. If there are more than one individuals investing in the real estate property, you could have all of the person's names on title to the agreement. This means each person would file their own respective 1040-NR in the US and their own personal tax return in Canada. Each person would pick up their pro rata share, of course. The third structure that I'm going to talk about is a little more complex. I'm going to talk about it on a high level only. Look at the diagram on the screen, please. On this diagram, you're going to see a limited partnership that's going to own the U.S. property. You're going to see a reverse triangle. This is a Canadian corporation that's the general partner, and this general partner bears all of the risk. And you're going to see individual investors known as the limited partners, who are individuals like yourself. You're only at risk for the amount that you invested. What's great about this strategy is that it's a complete flow-through. Any U.S. taxes paid will be credited to you here in Canada. Additionally, the majority of the risk is borne by the general partner. This structure works great when you have 2 or more individuals investing in U.S. real estate. Now, I know I went through this fast, but I hope you found this video helpful. For more tips and tricks, please go to my website, the URL for which is shown at the bottom of this video. Also, get access to your free report, 20 Tax Secrets on How to Beat the Tax Man. Thanks for watching, and see you next time.